Is Australia's property market a precarious house of cards waiting to topple? There's a property debate raging at present, and some are saying the future of the property market's bright, while others suggest our market's about to crash. After a number of boom years, especially in the Sydney and Melbourne property markets, we've entered a more mature stage of the property cycle, and obviously it'd be good to know who's right, especially if you're considering investing in property or about to buy a home. But remember, there's not one property market around Australia. Our markets are fragmented, not only from each state, but each state is at its own stage in the property cycle, and within each state, different segments of the market are behaving differently. So it doesn't really make sense to say the Australian property market is going to crash. Interestingly, I've heard many theories as to why the property bubble is going to burst. Some doomsayers are predicting a property crash because house prices have risen too high and they're now unaffordable. Others suggesting we've just taken on too much debt personally and as a nation. However, just because house prices are high or unaffordable to some doesn't mean we've got a property bubble. In fact, I'm going to give you 7 good reasons why the property markets won't crash. But first, let's have a look at how property markets corrected in the past. To understand what's ahead, looking at what happened in the property markets when they got ahead of themselves last time, should give us a good indication. For example, Sydney had a terrific boom in the late 90s up to 2000, right up to February 2004. In fact, it was one of the best performing property markets between 96 and 2004, helped in part by the excitement of the Olympic Games. After this boom, the property market corrected. It didn't collapse, it just corrected, with values falling from a peak to trough by about 9.3% over about 23 months. Of course, not all parts of the Sydney market dropped in value equally. Some areas held their value, and even in the regions where values fell, properties didn't plummet straight away. They gently followed a downward path. But the doomsayers were out there then, and just look what's happened to Sydney property prices between then and now. A similar pattern occurred in Brisbane and Perth, where values peaked in February 2008, and after a long boom in both cities, prices had actually gone well above the national average growth. Then again, the property markets didn't collapse, they just sauntered down, allowing fundamentals to get back into alignment. Just the same happened in the early 90s when we experienced the recession we had to have. After a remarkable property boom in the late 1980s, interest rates rose to a peak of about 17%, and the property markets around Australia just stalled. But once again, prices didn't collapse. They flatlined for a few years as affordability, supply and demand, and other economic fundamentals caught up. And when property prices peaked in late 2010, that's the last time the Reserve Bank raised interest rates, property prices gently eased in their major capital cities. They didn't plummet. The only time in Australia that property values dropped significantly, albeit for a short time, was after the Second World War and during the Great Depression. In the 1940s, house prices dropped 17% over a 2-year period, but then they jumped back again and grew strongly for many years after that. Property values also dropped during the Great Depression when unemployment was high, but times are different today. No one's suggesting Australia's heading for a depression. Look, sure, our economy is slowing a little bit, but it's still the envy of most developed nations. That's why talk of a property market collapse is nonsense. So why don't property markets collapse? Well, some do. Just look at the mining towns where values of some properties have fallen by over 50%, or some holiday locations like the Gold Coast. I mean, mining towns grew to dizzying heights driven by speculators, and the Gold Coast was also driven by a level of speculation more than the undersupplying demand fundamentals. And the large fall in prices was because there was just too much to develop a stock on the market. But my point is that in general, in our capital cities, property markets don't collapse because they are illiquid. People don't just sell up their homes because interest rates rise, or they don't sell up when times get tough. So what could cause a property market collapse? Looking at what happened in the past, both here and overseas, the factors that could cause markets to collapse rather than correct are a depression or a severe recession, but no one's suggesting that's likely on the horizon in Australia. Or if severe unemployment occurred, where levels were so high, a mass of people just couldn't afford to keep their homes. Again, this is unlikely to occur, with employment levels being as low as they've been for a long time. interest rates rising to exorbitant levels could cause mortgage owners to default. Hopefully the Reserve Bank won't allow this to happen, or if there's a huge oversupply of properties because developers have just built too many. Now, we're currently seeing that in some overheated inner city off-the-plan market segments, especially in Melbourne, Brisbane or Perth. And the last thing that could cause a collapse is if the credit market suddenly became illiquid, a credit squeeze. Currently, APRA are trying to slow down the growth of the property markets, but to underpin the banking system, not to choke the markets. That wouldn't be good for anyone. So let's have a look at a number of reasons why property markets won't fall anytime soon. First of all, we've got robust population growth, fueled by immigration and to a lesser extent natural population growth. Now, while immigration levels have dropped a little bit, we're still growing at a faster rate than any other country in the developed world. Number two, we've got a healthy economy that, while slowing a little, will continue to perform at the levels envied by much of the developed world, much of the Western world, and that's going to create jobs for anyone who wants one. We've also got a sound banking system with reasonable interest rates, tight lending practices and a low default rate. Recently, business confidence is rising as we seem to have a stable government at federal and state levels. At the same time, consumer confidence has been rising since Malcolm Turnbull was elected president. We've also got a healthy level of debt. Sure, we're borrowing more, but the debt tends to be in the hands of those who can afford it. Many Australians are saving more, taking on less credit card debt, paying off their mortgages faster. And so that really has improved the average personal household finances. This in turn reduces the risk of house prices collapsing if interest rates rise or the economy hits a speed bump. And the last sector I think that will help house markets are the culture of home ownership. 70% of us own our home or are paying it off, in contrast to what's happening overseas. In fact, half of all the homes owned have no debt against them. So what's ahead for the next year or so? There's no sugarcoating it. Property price growth is going to be lower in 2016. Decreasing affordability, changing sentiment and oversupply in some sectors such as the CBD and off the plan. That's going to create a volatile mix that will fragment and slow our property markets, moving some from sellers markets to buyers markets. In fact, that's already evident, isn't it, with the falling auction clearance rate, particularly in the city property market. Yet there's still strong demand for housing. People are still getting married, having babies, getting divorced, they're coming from overseas. If they can't afford to buy their homes, they're going to rent. And this is going to force rentals to go up. I think in the year ahead, as Australia's economy bumbles along, we're still going to see wages growth. And we're also going to see interest rates may be falling, but I don't see them rising until 2017. And both these factors will affect some suburbs more than others. What I mean by this is rising rates are eventually likely going to affect the suburbs that are more interest rate sensitive, like blue collar areas, regional areas, first home buyer areas. On the other hand, property values are likely to increase in the more affluent, gentrifying middle ring suburbs of our major capital cities, where locals' income is less dependent on CPI increases and where rising interest rates isn't going to impact disposable income as much. So my top pick for suburbs that are going to outperform are those areas where people have got high disposable incomes and are able to and prepared to pay a premium to live there. They're going to want to live there because of the amenities in the area. In Sydney, I see price growth of maybe about 5% over the next year. In Melbourne, it's probably going to be a bit higher, around 7%. Perth and Darwin's property markets are going to fall a bit further, and I think Hobart and Adelaide are going to keep bumbling along at the CPI level, while Brisbane should start to play catch up and maybe have 6 or 7% capital growth next year. On the other hand, I can't see any real reason for strong capital growth in regional or mining towns, which are not getting the growth drivers of jobs, of people moving in that is required for price growth. But rest easy, there won't be a property crash in our capital cities. So what are you going to do in 2016? If you're looking for independent advice to get into the property market or to secure your current portfolio, to check how it's going, why not have a chat with the award-winning team at Metropole? Let's help you cut through the clutter. Remember, the multi-award winning team at Metropole have no properties for sale, but access to every property on the market. So our advice is unbiased and independent. So whether you're a beginner or a seasoned professional and you'd like someone to help you formulate a strategy or review your portfolio, why not have a chat with us? Give us a call, click on our web link, and we'd look forward to becoming part of your wealth creation journey.